Okay, so I'm going to keep recording classes until we don't need to anymore. Got what I needed. Okay, now let's go back over to finance on Moodle so I can take attendance. All right, Emily Baker.
Here.
Matt Castles.
Here.
Peyton Ennis.
Here.
Okay, Evan Gerber.
I'm here.
Okay, Travis Harvey.
Here.
So-Yun Huang.
Here.
Salem. Salam.
He
Type
said
in
he's
chat.
here. His mic not working.
Every year, Salam, your mic doesn't work. Haruta Kuroda.
Here.
Okay. Connor Levick.
Here.
Okay. Destiny Merriweather.
I'm here.
Okay. Jeremy Meyer.
Here.
Haley Phillips.
Here.
John Retton.
Here.
Owen.
Here.
Lucas Sadowski.
Here.
Wow, everybody's here. Wonderful. Certain classes, that tends to happen. That's a wonderful thing. All right. So let's get me back to here. All right. So I can, let's see. All right. So anyhow, we talked quite a bit last time about what we thought the finance director of a company does, and those types of things. So I want to actually start going through what the book talks about and what they think that the role of a finance director is, or the finance department of a company is. And what the book talks about is the evolution. They start with the evolution of the department and how it's changed over the years, depending on what the country looked like. I kind of I've always liked looking at the historical, the way the things work historically. If you have when you start looking back at how things occurred or looked back in time, and you take a look at what was going on at that particular time. So the original, if you go back to the early 1900s, late 1800s, early 1900s, the finance department of companies basically was the mergers and acquisitions department, if you will. Their job was to basically try to find other companies that they wanted to go after, to attack and buy, that type of thing, so that the mega companies out there could become larger and more important. That changed over the years. Let's see. In the 1930s, because of the Depression, the role of the finance department went from mergers and acquisitions to assets protection and security, maintenance of liquidity, those types of things, making sure that the company could stay solvent. And in the 1950s, finance moved away from descriptive and definitional nature and became more analytical. So in the 1950s, we started looking inward in the finance department and started being analytical of the things that we were doing. At this point, the other things that would pay attention to would be cash and inventory management, capital structure theory, dividend policy, shifted from that of an outsider looking into the firm to that of the financial manager making the tough day-to-day decisions that would affect the firm's performance. Okay, modern issues is a risk return analysis. We look at the finance department as being the area that we're going to determine whether we want to take certain actions, and it's going to be the finance department that is going to do the weighing of the risk versus the return or reward. Continues to become more analytical and mathematical. The finance department is going to be heavily involved in the use of mathematics. We're going to do a lot of calculations, and most of our analysis is going to be done using mathematics. We're going to work out certain equations and look at different ratios and different numbers just to see if that's what's going to work for us. While increasing prices or inflation have always been a key variable in financial decisions, it was not important from the 30s till probably 1965. 1965, we started having inflation. In those years between the Great Depression and the mid 60s, inflation was something that would run maybe about 1% per year. It was relatively stable. It didn't move much. In the 1960s, we saw inflation start moving a little bit higher. And of course, in the 1980s, we saw inflation become a very big factor in the world of the finance people. We went through a period of time where we had inflation. We felt we had inflation completely under control for probably the past 10 or 15 years, where we saw inflation rates in the 2 to 3% rate. Something that could be actually probably budgeted for. You could pay attention and know what was going to be going on in the world. Don't know what we're doing now. You know, the world has become a different place in the past 18 months, if you will, or 2 years. I think the last inflation number I saw was 7% for last year, something along that line. So that is a very interesting change. Inflation coming back into the considerations here. One of the things about inflation, first off, let me ask you this: is inflation good or bad? Just generally. Evan, what do you think? Is inflation good or bad?
I mean, most people look at it from a negative sense, but I think like it depends on the rate, I would say, because like I mean, most people don't like it, so probably bad. But I think a certain amount, I think that's the way things have always been, and that's how it's always going to be, I guess.
Well, the other choices would be, you know, stagnant, so there's no inflation, or deflation, right? So stay with you, Evan. Yeah, is deflation good or bad? That would be dropping prices.
I'm not sure, to be quite honest.
Okay, that's fair. That's fair. Anybody want to weigh in on that? Is deflation good or bad? Okay, it's bad. Deflation is a bad thing. If you take a look at how most people run their lives, you know, you graduate from college, you get that dream job because you went to Thiel College, and you start making the big money, and you start living a life like somebody who has, you know, regular income and has the ability to buy things. You buy a car, you put it on credit, you buy a house, you take out a mortgage. In a deflationary cycle, prices are dropping. And although it may seem like a good thing, that's like, oh, right, great, gas prices went down, it's not going to cost me so much to fill up my tank. You know, but the problem is that those of us that have bought those big durable items, like your house, your real estate, if you get into a deflationary cycle, then what happens is you have a very good chance of having the value of the asset that is pledged against your loan actually become worth less than the amount that you owe on it. So what happens in an economy where everybody is upside down on their mortgage? Do you continue paying them $100,000 mortgage on the $80,000 house or $70,000 house? See, more people than we would like to think about it would say, no, I'm going to walk away from that. I'm just going to put a lock on the front door, and I'm going to walk away from that loan, because why should I pay $100,000 for something that's worth $70,000? So that would have a very disruptive effect in the economy. So deflation is not a good thing. being stagnant is interesting. I think it's also a bad thing. Inflation and Evan, you had actually given the answer perfectly, where you said that you think it's a good thing, but it really depends on what the amounts are. You know, if you look at inflation at a controlled rate, 2%, 3% per year, something like that, that's a controlled rate, and that's what we've had over the past decade or so. Pretty good. Because what happens is you make those purchases of those major durable items. Once again, going back to your house, your real estate, and you pay $100,000 for the house. And then after, a few years, you've paid the loan down a little bit, but the house is now worth 110 or 120 or, whatever, depending on how prices have gone. So now you automatically owe, you have equity in this purchase that inflation has created for you. You're paying down the loan, you have continuing, increasing equity in that asset that you own. And then in addition to that, with inflation, in theory, your wages are going up to track with inflation. So you're paying that older debt with newer money. So you've got more money to pay on the debt, which is staying stagnant in, based on the value of the year that you purchased, once again, using real estate as the example. So inflation is considered to be a good thing as long as it's under control. If inflation starts getting out of control, then it becomes a real problem. And we do have examples in history where inflation got completely out of control, and I think anarchy tends to raise its ugly head at that point. You've had examples of countries in third world countries where inflation was double, triple on a very short period of time, where people would physically have to have wheelbarrows to carry the money around to go buy things like bread. So inflation that's uncontrolled or too high is extraordinarily bad also. So controlled inflation we like. The other thing is that when I started my career, inflation was, I started my career in the 80s. So I was a young professional at the time that we went through the double-digit inflation years. I got my first mortgage. I bought my first house in that time frame. And the thing that I want to bring out to you is that you will see certain things that will track each other in the economy. So half the time, you're not going to know whether this is an economics course or if this is a finance course, but there are things that track economically. And if you look at inflation, interest rates will tend to track inflation. Okay, so when I was a young professional, we would look at the fact that interest, if you wanted to borrow money, of course, the interest rates were extraordinarily high. Once again, because the banks didn't want to be stuck with money, loaning money out today that's worth a lot of money to be paid back with money that's worth less in the future, especially if inflation is dramatic. But interest rates will tend to track with inflation. As inflation rises, so do interest rates. Now, once again, good thing, bad thing. Well, it depends on who you are. If you're a consumer and you want to go out and buy a house, then it's a bad thing because your interest rate on your house is going to be something dramatic. To let you know, my very first interest rate on the house that I bought in 1983. In 1983 is when I bought my very first house. And I had good credit, and my first interest rate was 14%. Now, in the environment that we have just been living through, mortgage rates were somewhere between 2 and 4%. Why? Because inflation is at 2 to 3%. Back in 1983, when I bought my house, it was actually 84 when I bought my house, interest rates were 12 to 14%. So my loan was tracking the interest, tracking inflation. Bad thing for me, right? But people who are retired, that have worked their careers, they're collecting their pensions, their Social Security. Most of those people, what they had done is they had saved their money to get to their retirement. And with most of those people, they were kind of afraid, to be honest with you, to be investing in stocks and things like that. Mutual funds were not such a big thing necessarily back then. So most people had what we would consider fixed income type investments. So if you were somebody who was retiring in 1980, whatever, and you had the majority of your life savings in interest-bearing securities, you loved it because you were making 8, 10, 12% interest on your investments. That was a hell of a thing. Okay, so when we started going into the more stable economy with the more stable interest rates, the group of people that were very unhappy about that were the retirees that were invested heavily in fixed income type investments, because they went from having theoretical 10, 12% interest rates on their investments, which gave them nice income levels, down to having their money invested in securities that were paying 1% or less, which, you know, if you're looking at those investments to create income so that you can pay your bills and live your life, not a good thing. Okay, so interest is one of those things that is going to be an issue out there. And when we talk about the finance director's job being to do the analysis of risk versus reward, inflation is one of those numbers that we have to be aware of, that we have to pay attention to. Because if you're going to invest any money, if you're going to do something, invest money in your company, you have to know what rate you have to beat. Let's say we have $100,000 worth of profit this week, or not this week, this year. And we have our choice of either taking that money and putting it into some sort of an interest-bearing account, or we can invest it back in our company. And if we're in an inflationary cycle type economy where we could take that $100,000 and put it into something that was going to get us a 10% return with very little risk, you know, some sort of government security or some sort of AAA bond that's going to get us a 10% return, then we cannot invest that money in our business if we cannot beat 10% return. There's your risk versus reward. Okay, well, yeah, we're going to invest that money, buy a new machine, and we're going to get a 6% return on our investment. Well, sorry, not going to do it, because we can get 10% by just going to the bank. Okay, so these are the interesting things that you have to look at as the director of the finance for your company. Okay, so what's inflation going to do as we move forward? Anybody want to take a look in their crystal ball and tell me, and we can start making some decisions on how to go into the future. You know, what's driving inflation right now? You know, who wants to take a shot at that? Emily, what's driving inflation today?
Trying to think of something specific, but just and just first of all, just in general, like the rising like cost of living. But I'm trying to think of anything in general.
Okay, Matt, how about you? What do you think? What's driving inflation today?
Continuously like overprinting money, which would then put more money out there, which would then lower the.
Sure, you're talking about all the stimulus stuff that's happened, right?
Yeah.
Yeah, and that's one of the theories that's out there, is that when the government starts overspending, you have too many dollars chasing too few goods, right? That becomes, you know, the basic rule of supply and demand. If we have too much money, it's just going to drive the prices up. So that's one theory that's out there. Couple that with this supply chain crisis that we keep hearing about, right? We have fewer goods because we're having supply chain problems. So I think, you know, my opinion is that inflation is being driven in by two different things. One is the fact that we've been putting more money into the economy in order to create this stimulus. And secondly, that we're not at pre-COVID, pre-pandemic production and supply levels. You know, I find it very interesting. You know, I live in the United States of America, and I go to my local grocery store and I see empty shelves. You know, I remember watching, you know, newsreels, you know, that's how old I am, yeah, you know, of third world countries, of people lining up in order to try and buy a loaf of bread that day because of the scarcity and of the supplies of things. So I think that, you know, it's a very interesting economy that we're living in right now. I have no idea if the supply chain side of this is ever going to get fixed. Obviously, if we put more goods into the economy, then it won't be so many dollars chasing fewer goods. We'll have more goods, so theoretically prices should drop. So I think it's both of those things coming together. Is this going to continue? I'm really at a disadvantage because since I'm stuck here in Pittsburgh, I can't give you an answer. At my office in Erie, I do physically have a crystal ball. I bought a crystal ball probably about 20 years ago just for things like this. And since I don't have access to it now, I can't give you an answer. But I'll let you know if I ever get back home. I'll get my crystal ball out and we'll find out. But anyhow, that's one of your problems as a finance director. You're going to be looking at what kind of a return do you have to have. Although it will make teaching this course a little bit easier because as I teach the course, we keep using rates of return of 5, 6, 7, 8%, and those numbers were very unrealistic in an economy where inflation was a 2% type thing. And in interest rates that were out there were basically only at the 1, maybe 2% rate if you were lucky. So at least now the numbers that we use in order to do the calculations will be a little bit more realistic. All right. Excuse me. The next thing that's I'm in chapter 1 in the book, by the way. Excuse me. The book talks about, you know, obviously the book was written pre-pandemic days. And so the most recent crisis that the book wants to talk about is the Great Recession back in 2008. Now, for those of you that are aware of this, we had a financial crisis in 2008 to 2009 that was brought on by basically the financial world, the banking world, not paying attention to the risk reward rules. What they were doing is they tended to make loans overextending to people who were not creditworthy. There's a movie out there called The Big Short. Has anybody seen that? It's an interesting movie, has a lot of big names in it, and it is about the cause. The movie is about what caused the Great Recession that started in 2008. And basically it was mortgage-backed securities that had no value. Banks were out lending money to people who couldn't afford the mortgages that they were being given to buy real property being valuable. The banks tended to not really care all that much, I guess. So they made a lot of very bad credit decisions. Well, bad enough for the banks. But then what happens is, because of the fact that the banks tend to not keep those mortgages, they tend to sell them to other entities to actually service them. The banks sold those mortgages to other entities who then wrap them up in investment vehicles, mutual funds, not necessarily mutual funds, but investment funds. And everybody that was buying these investment funds in the financial world, they were told, oh yeah, these are AAA investments, rated investments, because they're all mortgage-backed securities. So everybody out in the investment world said, oh, mortgage-backed securities, I can't lose. And then what happened was we had an adjustment in variable interest rates, and the people who were not able to afford their mortgages now couldn't afford their mortgages even more because of the fact that the interest rates went up, their payments went up, everybody defaulted on their mortgages, and all of these mortgage-backed securities, they all just went belly up, and many very large companies lost billions of dollars in this scheme, if you will. So there were a tremendous number of very big names that took a really big beating. Let's see, give you some names. Fall of 2008, Bear Stearns, the 5th largest investment bank, was forced to merge with JP Morgan Chase, which was a strong bank. September 2009, Lehman Brothers, the 4th largest investment bank, declared bankruptcy, and even Merrill Lynch had to be saved by merging with Bank of America. FDIC seized Washington Mutual in September of 25th of 2009. FDIC seized them. And again, JP Morgan Chase was called on to take on the banks that were failing. The Federal Reserve provided $540 billion to help stabilize the money market industry, and so that it wouldn't collapse. Chrysler and General Motors both filed for bankruptcy because of their financial woes brought on by the Great Recession. Gee whiz. If you were the finance director during this time and you were buying investments, see the issue here that happened, and you have to be careful about this because, and I'm going to talk about this in a few minutes, but a lot of companies out in the financial world, they don't make their money where you think they make their money. For example, insurance companies, they don't make their money on your premiums. The fact that you pay a premium on your life insurance, excuse me, or you pay a premium for your car insurance or your homeowner's insurance, they're actually not making money on your premium. The way that their business plan is structured, they tend to just about break even on your premium payments. The premiums that you pay are just enough to pay for the administrative costs of running the insurance company and the and the claims that they expect to make during the year. So how do they stay in business? Well, there's one thing that happens. You pay your premium in advance. So they have all of your money up front. Then they go through the year spending it on administration and claims. But during the time that they have your money, they invest it. Okay, so insurance companies have gobs of money, gobs of cash that they end, it ends up petering away as the year goes along. But at the beginning of the policy period, they've got so much cash that they invest it. They're out in the financial world investing in whatever security they believe is going to give them a nice return on that investment that they'll be able to liquidate as they need to pay the operating expenses and claims. But the profit of an insurance company comes from the investment side. Banks, oh, how do they make their money? Oh, I know that every time I go into the bank, they charge me some sort of service charge. Yeah, there's all kinds of service charges. And oh, yes, the banks are charging interest on the money that they lend out. Yes, that's all true. But they also have an investment department. They have your money. Yes, they're making money on the loans, collecting interest, but the other cash that banks have is invested. They're out in the market investing, trying to get a return. So if you look at the fact that the financial markets were in danger of collapsing in 2008, 2009, all of these large businesses that are built in the financial world were in danger. Okay, so that's why Washington National was an insurance company that failed and had to be rescued. Why? Because they were invested in companies First off, it may have been invested in the mortgage-backed securities directly, or they may have been invested in companies that were invested in those mortgage-backed securities. Any way you look at it, they were teetering on the edge of bankruptcy, which meant that there were a lot of people out there who were not going to have the insurance that they thought they paid for. So they had to be rescued. Why? Because their investment department drove them into bankruptcy. Okay, so how do you deal with that? You know, if I was the finance director of a large company and trying to determine what type of investments my company should be in, I don't know that I would have picked up on the fact that these mortgage-based securities were basically fraudulent. Yes, there were people out there. If you watch the movie The Big Short. If we were actually in class together, I might just show it as a class, but where was I? If you look at that, there were people that were saying, hey, a crisis is coming. But then again, there's always somebody saying a crisis is coming, isn't there? So how do you know when to listen and when not to listen? But there were people that knew that this problem was coming. So, all right, how does the government react to that? They pass all kinds of reforming type legislation. The big one that's out there is the Dodd-Frank Act, which basically requires financial companies to take a much bigger, better look at the way that they take risk. Okay, so I don't want to go through Dodd-Frank. If you become the finance director of a Fortune 500 company, you probably should sit down and figure it out, but not something that we're going to deal with too directly in this class. All right. You're the finance director of your company, and it is 1993, 4, 5, 6, somewhere in there. Technology is changing. Everything is being computerized. How do you deal with that? I remember it was a big deal. I was working as the treasurer. I was the treasurer of a company. It was a fixed-based operator on the airport in Erie. Basically, we were a big gas station that fueled planes, did repairs to planes, chartered planes, that type of thing. And our biggest expense was our fuel purchases from our suppliers. And this would have been 1986. And it was a big deal that I was able to pay my fuel suppliers by phone. I could just get on the phone and I could authorize a payment. And instead of me having to write a check and mail it out, and I was able to wait to the very last minute, contact my bank, and the money would be sent directly to them. I would get my invoices paid on time. I would be considered a good customer, but I was holding the money as long as I could. It was like, wow, this is wonderful technology. Where's technology today? Now, do you have to, if you consider this being the finance director of your company, do you have to embrace technology? What do you think, Peyton? Are you embracing technology?
I mean, I guess if you were in the workforce back in the 80s compared to today, maybe a little bit, but I mean, it's kind of just everyday life today. So I don't know if you're embracing it so much so, but
yeah, because it's part of everyday life, you have to have embraced it, right? If you were trying to work in the old ways, you'd be a dinosaur, wouldn't you? Yeah, so you have to be aware. Go ahead, go ahead, Peyton. But yeah, you have to have done that. You have to be keeping up with the new technologies. So what do we have out there? The way the businesses are run today versus the way when I was, when I was a young professional in the 1980s, everything's dramatically different. We have, the way that we use computers, the way that we use digital technology, the way that we can communicate with each other is significantly different than the way it was 10 years ago, 20 years, 30 years ago. It's dramatically different. Okay. So one of the most interesting things that I saw, one of my wife's cousins was working as a buyer for General Electric. And I asked him about his job, and I said, so you're a purchasing guy for General Electric. I said, so basically, GE tells you that they need, 100 tons of steel, and you call the steel mills and find out who's got the best prices. Is that your job? He laughed at me. He said, oh, hell no, that's not the way this works today. And what he described to me, and this was probably at least 10 years ago, so I don't know how it's developed since then. He doesn't work there anymore, but at the time, they had set up a computer program that was like eBay, so to speak. And what was happening is GE was running reverse auctions for the ability or the right to be a vendor for GE. So if they wanted to buy steel, if you were a steel manufacturer or a steel distributor, whatever, you could get yourself registered with General Electric as a bidder. And so General Electric would then post out on their the website that they needed 100 tons of this particular type of steel. And then if there were, say, 5 or 10 steel manufacturers that wanted to do business with GE, they would look to see if they had the ability to deliver the steel according to the specifications that GE had posted. And then they would then bid the price that they would charge for that steel. And then after whatever appropriate time frame had, just like on eBay, the bid comes to an end. The bid would come to an end on the GE purchasing auction, and then whoever the lowest bidder was would win. I thought, my God, that is a tremendous advantage in technology now. It's basically just his job was to basically post the things out there, wait for the clock to run, and then inform whoever the successful bidder was that they needed to deliver steel, that type of thing. I thought that was really great. I thought, in my mind, that was something that was amazing. I'm sure that it's changed dramatically for the better since then. We talk about business to consumer transactions at this point that you can do digitally. So there's a lot of companies right now, because of the advent of the internet and the ability to be able to communicate directly with buyers rather than having to go through wholesalers and other retailers and whatnot. You have manufacturers who have the ability to sell directly to their customers now. The B2C, the business to consumer standard here. And then you've got your business to business, the B2B technology, where and I would guess that GE bidding process would be a business to business type technology. But you just let it, you have to be up on the I don't know that you have to be on the exact cutting edge, but you certainly have to be paying attention to the technology that's changing around you, because as people move to technology, it's obviously, hopefully, making things more efficient and making things easier. So then you end up, if you don't make those changes, you end up less efficient and not being able to be as profitable. All right. There's discussion about the activities of financial management on a daily basis: credit management, inventory control, receipt and disbursement of funds, occasional stock issues, bond issues, capital budgeting, and dividend decisions. And in that entire time frame, in that entire portal, you're worrying about profitability. The one thing that I hadn't talked about prior to that is credit management. Now, credit goes two ways. Keep in mind that you have to be the one who's out there trying to maintain your relationships with your banks and be able to borrow money, especially as I talked about last class, the ability to borrow money for working capital to make the cash flow problems, ease over those. When you have a lack of cash, but you're profitable, you need to be able to pay your bills. You need to be able the person who's making those arrangements to make sure that you have cash. But in addition to that, keep in mind there's another, and I'm going to call it a banking relationship that goes on in a business, You are selling to your customers probably on credit. Unless you are a retailer like Walmart and somebody brings an item to the cash register and wants to buy that big screen TV, they're going to pay you for that big screen TV before they're allowed to leave the store with it, right? Well, in the business world, if you're a wholesaler or if you're a manufacturer or you're a whatever, you're selling on credit. You're giving your customers credit, usually 30 days. Now, we'll talk about other ways of changing that time frame, but in the business world, companies expect that you're going to give them 30 days to pay for the product that they buy from you. That's a banking relationship. You have to make these banking decisions. You are the bank in these circumstances. Keep that in mind. And you need to act like a bank when you're making these decisions. So when it is listed as number one as your day-to-day activities as the finance director, that is exactly what we're talking about. You get a new customer that comes to you and says, hey, Gamalchak, I want to buy widgets from you. Hey, I want to sell widgets because I make money when I sell widgets. Great, I want to take you on as a customer. You got to go talk to my finance director though, because he's in charge of the money. Hey, we want to buy widgets from you. Great. We want a new customer. We'd like to be able to buy them on 30 days, same trade credit as everybody else in the world. Well, maybe. Why don't you give us a chance to do a little bit of a credit check on you? Why don't you give us a little bit of a chance to take a look at your financial records? Why don't you send us the last 5 years worth of your financial statements? Give us a recommendation from your banker that tells us that you're in good standing with your bank. And then we'll make a decision on whether or not we want to lend money to you. Because see, don't lose track of the fact that you are acting like a bank. You're lending your customer money to buy your product. So that is a big decision that you need to make, because see, if I sell $100,000 worth of widgets to Acme Company and Acme doesn't pay me, I've just lost $100,000, not because the machine blew up or not because we made all kinds of mistakes in manufacturing. No, because I made one mistake and trusted somebody that I shouldn't have. That's another big part of your job. Okay, how do you do that? How do you make those decisions? Well, in my example, I gave a few. I want to see financial statements for some period of time, maybe not 5 years, maybe 3 years. I want to see the last 3 years worth of financial statements. I want to have a reference from your banker telling me that that they like you and that they're not constantly chasing you for payments. And then I'm going to do a credit check. How do you do a credit check on a company? Anybody know? Do I go and look for the company's FICO score? Do I go to Experian or who are the other ones out there? It's the three big ones. I don't remember their names, but do I go there? No. There's a whole separate system set up for businesses, and it's called Dun & Bradstreet. Okay, and if you are, I remember when I worked at the company where we manufactured industrial shelving. Before we would sell to anybody, it was my job actually to run the Dun & Bradstreet report. So at that time, we had a computer terminal that was linked directly to the company Dun & Bradstreet, and we would just type in the name of the company, and we would get back a Dun & Bradstreet report. I'm sure it's all done over the internet now. I'm sure you still have to be a member in order to access that information. I'm sure you have to pay for the privilege of getting that information. But then again, a Dun & Bradstreet membership, whatever the cost is probably a lot better than taking a wild guess and losing $100,000 on a deal, right? But yeah, there is this method of doing that. It's called Dun & Bradstreet. I don't think it's really referenced much in this book, but in the if you remember from business law, we did talk about them there. Okay, so credit decisions. It's another big thing that's out there for you. All right, the next thing I really want to talk about, just as we start going through getting in, sort of acquainted with our business that we're going to be making decisions on, let's just go through the structure, the the type of entity that you may have that you're making these decisions for. Okay, and there's really 4 big ones that are out there. There's the sole proprietor, there's the partnership, there's the corporation. We can also include the S corp there, and we also have the limited liability company out there. Okay, now the sole proprietorship is the easiest type of business to get into. I can just decide, I can wake up in the morning and decide, you know what, I'm going to go into business today and start acting like a business owner, start trying to find things to sell and then trying to sell them. I've become a sole proprietor. Yeah, I may have to sign up for a tax license, or I may have to get some sort of, if I want to open up a restaurant, I'm probably going to have to deal with the health department or something. But as far as the legal side of it and the tax side of it, the sole proprietor is you. If I decide to go into business and I want to open up a restaurant, I'll have to have permission from the health department. I'll probably have to get a sales tax collection license. But beyond that, I don't have to ask the government for anything. If I want to have employees, I have to have an employer identification number. But legally, the business is me. If I go to work that day and I open up the restaurant and I cook breakfasts and I sell breakfasts, and I end up making $500 that morning, and it cost me $300 in eggs and bacon, I made $200. Not my business. My business didn't make $200. I did. It goes directly to me. There is no difference between the company and the owner. It is just the owner acting in a profit seeking manner. Okay. Understand that. If that business fails, if I buy, $10,000 worth of bacon on credit from some bacon distributor, and all of the sudden my business goes downhill, nobody wants to eat at my restaurant, and the bacon spoils, and I still have to pay for the bacon. I can't go to the bacon guy and say, hey, you know what? The business is out of business, so you're not going to get paid. So sorry. He's going to go, no, the business is you. You're a sole proprietor. You still owe me this money, and I'm going to sue you for the $10,000. And he's exactly right. Okay. A partnership is the exact same status as a sole proprietor. Only difference is there's more than one owner, 2 owners, 3, 4, 5, whatever. Could be whatever number. There's no maximum number, other than the fact that as a partnership, if you have too many owners, it'll get kind of cumbersome, because see, every owner has the right to run the company. So if I take on a partner and there's 2 of us and we're running this restaurant together, well, it's kind of easy for the 2 of us to get together and make decisions because there's only 2 of us. If he decides to buy bacon from a different supplier than me, excuse me, he has the authority to do that. And I'm going to owe the money, and he's going to owe the money. If the business goes broke, we still have to pay the guy for the bacon. Okay. We are the business. The business and the owner don't have separate identities legally. It's all the same person. So if the business makes money, no, I made money. If the business owes money, no, I owe money. Okay. Understand that there is room in the world for sole proprietors. There is room in the world for partnerships. Okay. But they don't fit every need, which is why we move to the next one, which is a corporation. The big difference between a corporation and a partnership and a sole proprietorship is limited liability. See, the thing you have with a partnership or a sole proprietorship is that you have unlimited liability. Whatever debts are created, going back to a sole proprietor or a partnership, whatever debts are created, those debts belong to the business, but the business is the owner. So those debts, those liabilities belong directly to the owner. If the business fails, that money is still owed, and it's owed by the owners. They can come after your personal assets. I own a house, I own a car, I own a boat, I own a, whatever. If I fail as a business, the people I owe money to, they can come and try and take my house. They can come and try and take my car. They can take my boat, whatever they can get, they'll take. Okay, so everything that I own is at risk if I'm a sole proprietor or a partner. That's what's called unlimited liability. With a corporation, we have limited liability. If you form a corporation, then what happens is the corporation and the owner are two different legal entities. I own stock in this corporation, but that corporation is a legal entity. The state of Pennsylvania, if I ask the state of Pennsylvania for permission to create a corporation and they issue me a certificate of corporate standing, then I have created a new entity. I gave birth to another entity. Okay. So if I decide to open up a restaurant and I create a corporation to run that restaurant, that corporation can own the assets. That corporation can get into the lease agreement with the owner of the building where the restaurant's going to be. The corporation can get into contracts to buy the eggs and buy the bacon and buy the coffee. If that business fails, can those people that are owed by the company, can they come after my personal assets as the owner? The answer is no. Okay, that's what's called limited liability. The people who are owed money by the business can try to collect their money from the business. They are not allowed to go through the corporate shield to get to the owners. So if that business fails, those people can only go after the money at the corporate level. Now, do I lose money? Sure. I lose my investment in the business. So if I had invested $5,000 in the business and the business goes bankrupt or goes out of business, I've lost my investment in the company. Okay. But if we owed $100,000 to the bacon guy, he can only collect that money from the corporation. He is not allowed to come after my house. Why? Because I incorporated. I have what's called the corporate shield. Okay, that's why you incorporate, because a corporation is not advantageous tax-wise. I cannot, if I have a C Corp, then the earnings of the corporation are actually taxed twice. The corporation has to pay tax on its income, and then the corporation will declare dividends to distribute profits to its owners, and then the owners have to pay tax on those dividends. So it's a double taxation. You don't get into corporate form because you like taxation. You get into, for those of you that had corporate tax last semester, speaking to the choir here. So there's disadvantages to being a corporation. Now, we can change that. If you're a small business, you can be what's called an S Corp, which means you choose to be taxed more like a partnership, which means that instead of the tax being paid at the corporate level, the tax is paid by the owners. The income and expenses are reported out to the owners, and then they pay the tax on their own tax return. But the limited liability is still there. Okay, so if you're a small business, if I was going to open up a restaurant and it was going to be me and one of my friends were going to be the owners, we would probably do it as an S Corp because we don't want to have a lot of owners, and it doesn't matter as far as who's in control because both of us are there and working at it. That's fine. We would be a corporation. We would probably choose S status so we didn't have double taxation, but we'd still have limited liability. Okay. Now, one last step is the limited liability company, the LLC. Now, the LLC limited liability. It's right in the name. So it has the same concept of limited liability like a corporation does, but by its very nature, it is considered to be non-taxable at the entity level, only taxed at the ownership level. So it acts like a partnership, it acts like an S corp, but it's not a corporation. It's this other entity, a limited liability company. Most people treat them like partnerships, but it's got limited liability. All right, now, why would I want to be a C corp as opposed to an S corp? S corp, I only pay tax at the ownership level, pay it once. C corp, I have to pay tax twice. I have to pay it at the entity level, and then I have to pay it at the individual level when I distribute dividends. Why would I want to be a C corp? Jeremy, what do you think? Why, Evan? I saw you turn your mic on. Evan, what do you got?
Yeah, well, S corps can only have, I think, 100 shareholders, and C corps can have as many as your market cap is.
That's exactly right. What would happen is if I want to be a very large company and I want to sell my stock to the public, that means I'm going to end up with a lot of owners. If I'm a S corp, I can have a limited number. 100 might be the number. I'd have to look it up also. But if I want to have more than 100 owners, I have to be a C corp. A limited liability company is also too burdensome to have that many owners. So the way that we structure things in the world today is you're going to be a C corp if you're going to be a large company with large capitalization with a large number of owners. Evan's exactly right. Okay. All right. So that's why we have C corps, because we want to be big, we want to have lots of money, and we want to have lots of owners. All right, in your book, the next thing that they really want to talk about is corporate governance. How is a corporation run? Well, we have the owners, but the owners do not run the company. We have the board of directors, but they don't run the company. And then we have the officers of the company. They run the company. The way that it works is the shareholders put their money in. They're the actual owners. They're the ones who are going to share or participate in the profit or loss. They're the ultimate ones who gain or lose by the operation of the company, but they don't have the ability to run the company day to day. Once again, if we had 100,000 shareholders, that would be very difficult to run a company with that many people, very cumbersome. So we don't give them the ability to run the company. They have the authority to elect the board of directors, which is going to be a smaller group of people, maybe a dozen, maybe 20 people in a massive Fortune 500 company that are going to be the board of directors. I said they don't run the company. Well, they don't run the company day to day, but they're the people who are supposed to be in charge of the vision of the company. What do we want to do? What do we want to be? What do we want to manufacture? Should we expand? Should we carry this particular product line? Should we declare dividends and pay earnings to our shareholders? They are the big picture people for the company. They have the power to appoint the officers of the company. The officers of the company, which now could be a much larger group, depending on the size of your company, president, treasurer, secretary, a number of vice presidents, okay? They run the day-to-day process of the company, okay? So owners are affected by the profits and losses, elect the board of directors. Board of directors are the visionary people who say what the long-term goals of the company are. And then you've got the people who are short-term day-to-day running the company, which are the directors. Now, we have had problems in the past with this structure. And although this is now, time marches forward strangely for you. I lived through the events that led to the Sarbanes-Oxley law. Now, Sarbanes-Oxley was passed in 2001, I think 2002, because of abuses in the corporate world, in the finance world, in the very late 1990s. The big companies that you will hear mentioned that were the poster child, if you will, of the of this scandal would be Enron and Worldco. These are companies that basically were required to publish their financial statements by sending them to the Securities and Exchange Commission because they were publicly traded companies. That way, all of the owners of the company can see the financial statements and know what the company is doing, what it's worth. Also, the other people in the financial world, the investment world, could make decisions on whether to invest in the companies or not based on their reporting, their disclosure of their financial statements. These companies lied on their financial statements, and it did a lot of bad things, so it led to a lot of fraud. Enron had published its financial statements, basically ignoring a lot of their liabilities. Well, if I didn't have to report my liabilities on my financial statement, I'd look like I was rich. If I didn't have to show all the people I owe money to the bank for my car, I owe my money to the bank for my real estate. If I could just list all my assets and not list my liabilities, I'd look pretty rich. Well, I'm not rich because I owe a lot of money to a lot of people to have the stuff that I have, right? Same thing with Enron, but they decided not to bother telling people about the money that they owed. So they looked like this very strong company, and their stock price was ridiculously high because of how strong they looked. Well, then when it came out that they were lying and they were really not anywhere near as strong as they pretended to be, the people who had bought Enron stock at $150 a share because everybody thought it was this strong company felt like they had been defrauded because it was really only worth about $1.50 a share type thing. Led to the government stepping in. We talked about Dodd-Frank a little while ago. Now we're going to talk about Sarbanes-Oxley. Sarbanes-Oxley is a law which requires companies to report their information correctly. In the old days, what would happen is you would have the CEO of the company signing off on the financial reports that they would send to the SEC, and they would sign it saying, we're certifying that these are correct. Well, when enforcement started coming back against these CEOs for signing these fraudulent reports to the SEC, the defense was, well, we didn't know. I'm not an accountant. I didn't know what any of this meant. I didn't know we were lying. How would I know? So now what happens is under Sarbanes-Oxley, the CEO has to sign saying that he has taken whatever steps were necessary to assure himself that the information is correct. The CFO has to sign the paperwork saying that he is certifying that the accounting work was done and it correctly reflects the position of the company. They've created criminal penalties for lying and reporting fraudulently to the SEC. And some oversight boards were appointed to keep track of the people who are practicing in front of the SEC, both accountants and lawyers. And so if you are considered to be somebody who's lying all the time, then you won't be able to practice in front of the SEC. So that's Sarbanes-Oxley. All right. So now what we have to do is we have to see how you're going to make your decisions. Here's another one of the things that becomes a problem that you're going to have as a finance person in a company. Should you be looking to maximize profits at all costs? Should your goal be to maximize profits? What do you think?
Depends.
What's that, Owen?
It depends.
You guys are getting too good at this. Depends is actually the right word. And what you're going to find is you're going to find certain groups that are in the ownership or management of the company that will have different goals. Okay. So theoretically, if you're on the board of directors, You are involved in the long range planning of the company. So today's profits at any cost should scare you, because you're concerned with the long range goals in the long run here to make sure the company maintains all of its strengths and can continue to be profitable and competitive in the long run, 5 years, 10 years down the road type thing. Whereas if you consider the wants of the shareholders, they want to see maximized profits, because the more profit the company has, the higher the dividend that the company is going to pay. So they're going to receive back income on a current basis because of the fact that you were pushing for higher profits. Okay. The problem is that what can happen is that this attempt to get the highest profit at any cost, you may be mortgaging your future. Okay, the decision to maximize today's profit may come at the cost of you not being competitive in the future. So yes, I was able to beat all of my competitors because they took the time to slow down production and retool to become more efficient. But I just kept pounding away because I felt there was an opportunity for me to get profit while they were out of the market retooling. And that's what happened. I made a significant profit because I took so much of their business because they were retooling. But then what's going to happen next year when they come back online, much more efficient, and I'm still using old technology, I'm going to end up in a hole then, you know. So long run, that may not be the right answer. So welcome to the world of the finance director. You have one group of your bosses that say, we have to have profits, highest profits as we can at any cost right now. And another group saying, well, we want to have profits, but we have to make sure that we have the future available to us. So we don't necessarily want to make decisions that are going to create higher profits, but hurt us in the long run. Good luck. You got different bosses that want different answers. One of the goals they talk about is that you should be trying to maximize shareholder wealth. Okay, so I'll ask you this right now. And Jeremy, I'm going to ask you this question. What does a shareholder of a publicly traded company want? What do you think, Jeremy?
Sorry about that. Really, they want to earn their fair share in their dividends.
Right, they want dividends. And what else? Anything else? Well, they actually want two things. The shareholders want dividends. They want the dividends to be as high as they possibly can, but they're also looking for appreciation in the value of the stock. Okay, so if I buy the stock for $10 a share, what I eventually want to see is I want to see the company paying me dividends back, but I want to see the company's share value going up over time. So if I hold the shares for 5 years, they're going to be worth more than the $10 that I originally paid. So they want two things. They want dividends, and they want appreciation in the value of the stock. So the answer to the question as to what the job of the finance director is, you have to please both of those masters. You have to be able to pay dividends, and you have to be able to increase the value of the shares of stock. How do you increase the values of the shares of stock? It's not like you control it. It's not like you can go out and, not like retail and you can just go raise the price of something by changing the price tag on it. Well, you have to run your company in a way that the investors feel that you're running the company well. You have to make good projections. You have to hit those projections. You have to be profitable. You have to have people think, yeah, that's a company I wouldn't mind investing in because I think they do it right. So that's the way that you run your job. Good luck making everybody happy when you're only making half of them happy at a time. All right. Social responsibility. In the master's course, course of study, I teach a class called Social Responsibility, Corporate Social Responsibility and Sustainability. And what it is it's about whether or not or how corporations behave in society. Should a corporation be a good citizen? Is the corporation's sole job to create a profit for its shareholders, or does it have the responsibility or even the authority to act socially responsible? Owen.
It depends.
No, I'm not going to take that this time.
Darn. I would say if it would be mostly what the corporation's main goals are. I feel.
Yeah.
So if they're into like biotech, you know, maybe yes, they have a social responsibility to pursue things that are good for the environment. Or if
Okay.
they're into manufacturing, maybe they're looking to crank out as much, be as profitable, and you know, maybe at the side provide the local community with a lot of jobs.
Okay, that's certainly something that the community wants, is they want the jobs. What if you're a company like Exxon now? You know, Exxon is please don't get on me about this, but you know, you could make the argument that Exxon is very responsible for global warming. And they've made, you know, gazillions of dollars doing that. What's Exxon's responsibility? You know, community-wise, okay, yeah, we'll give you jobs, but what about to the rest of the world? You know, we're going to make the world unlivable because our product is creating, you know, carbon emissions that are ruining the atmosphere and creating global warming. The bigger question here is whether a company is even allowed to make those types of decisions. Because see, let's say that I'm a company that pollutes, and I'm in an industry that pollutes. I make cars. Let's say I'm General Motors, and I know that I could start spending money to make my manufacturing plant, more green. I could spend money to make my product more green, and I would be doing a wonderful service to the world, to you know, community in general. But if I do that, and I'm the only one of the automobile manufacturers to do that, can I do that? That becomes the question. You know, one of the problems you have is if I do it and Ford doesn't do it, then Ford's cars are going to be cheaper than mine, and I'm going to lose business, right? Or I have to make my product more expensive, or, you know, there's a whole lot of ramifications from making those decisions. So first off, I'm going to tell you that, oh, we live in, you know, when you had your economics classes, we have what, laissez-faire, free market economy, right? The government should keep its hands out. We have anti-pollution laws out there. Why? Because nobody would do it if they weren't forced to. Because if General Motors were to do it and Ford wasn't going to do it, then General Motors would go out of business because Ford would be cheaper and more profitable, and then General Motors would cease to exist. So they wouldn't do it. So certain things have to be done so that the entire industry is harmed. That way nobody, you know, we can continue having competition and still get the social reward that we want, breathable air. Okay, take it beyond that. Can I do it? Now, there are people that'll tell you, no, your job is to maximize the profit for the company. If you want to go on some sort of a social rampage to try and help the society, use your money. Because if I'm a shareholder and you reduce the profit of the company, you're taking that money out of my pocket as a shareholder to do your social work. And that's not fair because it's my money, not your money. Anybody want to agree with that argument? It's a legitimate argument. Many people believe in that. However, And oh, those are the people that will say that you absolutely don't have any right to do anything that would cost me profit. Thing is, in the world, that is not the prevailing belief. Some people do believe it, but that's not the prevailing belief in the world. The world does believe that it is possible for a corporation, for a business, to be socially responsible, to do things that will make the world a better place, to give money. For example, once again, if you look at a corporate income tax return, there is a deduction allowed for charitable contributions. Making a donation to a charity does not improve your profit as a business. So it's not considered illegal for you to do things that reduce profit that help the world. Okay. So if you want to make your company more green, if you want to make your company a good corporate citizen, a good world citizen, global citizen, you can do it. Now, you may have unhappy shareholders. They may want to sell and get away, and other people may not want to buy in. So it might affect the value of your shares, but you are not going to go to jail. It's not illegal. So being a responsible company is possible. Now, you're going to have to make sure you're still making a profit, right? Because if you don't make a profit, you're not going to stay in business for too long. So you have to be able to balance your profit motives with your social responsibility motives and make sure that you haven't irritated your shareholders too much. All right, I'm out of time. That's all we have for today. We will pick up again on Tuesday, finish off chapter 1, move into chapter 2. We will be remote still. I don't have any indication that my son is going to be discharged from the hospital just yet. So we will stay remote until Tuesday. If anything changes, I will email all of you to let you know. But assume that we will be on a Zoom meeting again on Tuesday. The sign-in information that you have should still be valid for that, because I just set this up as a semester-long repeating meeting. So any questions, comments, complaints? If not, then we'll see you guys on Tuesday.
Have a good day.
Thank you, sir.
Have a good day, Professor.
Thanks,
good day.
Travis. Thank you.
Have a good day and a wonderful weekend.
Thank you, Owen.